Hi, today we are going to start chapter 2, which is really a review of accounting that you did in your accounting class previous semester or earlier. So some learning objectives of this new chapter are going really through all the financial statements and then build up on the information later on in the semester when you do the calculations of profitability ratios and other financial type of analysis. So some topics to discuss: income statement. This recording is going to be basically about the income statement. Then price earning ratio. Then we are going to discuss balance sheet, another recording with theory and applications. And then statement of cash flow, that's the last statement to analyze. And then also depreciation is a topic related to cash flow. So those are the three basic financial statements you learned in your accounting class: income statement, balance sheet, and cash flow. Income statement. This is the one that measures the profitability of the business for a period of time, usually 1 year. And this is different than the balance sheet, which is another statement that's a cumulative type of statement showing assets and liabilities since the beginning of the business. So income statement just for a determined period, is usually 1 year, and presented in step fashion. You start with sales, then you subtract all the expenses that we are going to show in the next slide. And this is an example of one corporation, Kramer Corporation. This is how an income statement looks like. For 1 year, 2015, sales, they sold merchandise in value of $2 million. The way they calculated this number is quantity, how many units they sold, times the price per unit. This is how you have sales in dollars. Cost of goods sold, how much it cost them to produce the units they sold over here. Cost per unit times units sold. In this case, 1,500,000 out of 2 million. That means the cost of goods sold alone is 75% of the sales, which is on the high side. Gross profit, 500,000, the difference between sales and cost of goods sold. We subtract then other selling and administrative expenses, depreciation, 50,000, and then we subtract them, and what's left over, it's called operating profit or earnings before interest and taxes. Then interest expense. This expense is it refers to the interest we pay on the money borrowed. When you have one or more loans, you have to pay it back plus some interest expense. That's the one that's here. We subtract it, and then what's left over is earnings before taxes. In this case, taxes are given 49,500. Usually, it's the taxes are given as a percentage applied to earnings before taxes. 35% in this case is already calculated for you. We subtract those from earnings before taxes, and what's left over is earnings after taxes or net income. Now a little bit of theory. This net income belongs to common stockholders plus preferred stockholders. Preferred stockholders are paid first all the time. All the dividends that belongs to them, we have to pay them first. Preferred stock dividends by contract. They are fixed and they get paid first. After we pay them, we subtract the dividends, and what's left over in this case, 100,000, belongs to common stockholders. And to find out earnings per share, we divide earnings for common stockholders by number of shares, and that's the earnings per share. What's the book value? What's the book value for earnings for this business? In this case is $1. In reality, the numbers are not so even, but I guess this example is made easier for you in the textbook. Now that's the same type of information, but it shows what we just discussed on the previous income statement, how you subtract all the cost elements from sales to make it all the way to net income or earnings after taxes. So that's the theory about income statement. Now I just go back a little bit because I just want to mention here that this 100,000, how much money common stockholders made this period, they are going to be split between dividends for them. They are going to take home as dividends some money of this, and then the rest is going to go into the so-called retained earnings. Money put back by common stockholders for the business to grow. And that's just to wrap up the information about income statement here. When in general the business needs money, sources of finances for their day-by-day activities, they can issue bonds, and then they are going to pay at a later date the bondholders plus some interest for them. They issue stocks, and then later on they have to pay the preferred stockholders dividends, and they can issue common stocks and sell them to receive money, and later on pay them dividends. And earnings per share, we already discussed them in income statement. We pay preferred dividends first, and then common stockholders, some go in dividends, some in retained earnings. And this is the statement of retained earnings that I mentioned earlier. This is a cumulative type of statement because it shows how much money common stockholders put back into the business since the beginning of the business. In this case, for our business, we have retained earnings balance before this year, 250,000, plus how much money common stockholders made this year, 100,000, and they take back, as you remember from income statement, 50,000, and then the rest, 50,000, goes back to the balance from the beginning of the year. So this year they are going to end up with a total of 300,000. After this theory part about income statement, you are going to switch to the applications on income statement and listen that recording there.